A third day of gains on the cards, do you think?
No, not really, because if you look at yesterday's gain, it was mostly, especially in the 20-share index, it was mostly driven by the brewer, East African Breweries Limited. There was a trade of about 700,000 shares at 165 shillings, which was about 5 shillings above the closing price the previous day. So I think that's what really drove the gain we saw on the, on the 20-share index.
So what's your outlook for the rest of the market today?
I expect today to be a pretty slow day. It's Friday. Fridays are always slow days, Fridays and Mondays. So I don't expect much. We might actually see some sort of decline. Yesterday, the trade on East African Breweries Limited created some sort of excitement in the market. We don't expect that today. So we may hold steady or see a slight decline.
Right. I was looking at the trades on East African breweries and I was thinking to myself, sure, I understand the reasoning behind perhaps the expectation that their earnings are going to be boosted by the Christmas spending period and the holiday spending. But at the same time, we've got SAB Miller coming into that market. And we know that SAB Miller is becoming indeed the big gorilla. They've just taken over Foster's in Australia. Therefore, in terms of muscle, financial and otherwise, we're talking here about a big competitor. Are investors perhaps taking here a nationalist view and trumping good investment sense thinking?
No, it's true. SAB Miller will be quite a competitor, but not in the next 18 to 24 months. They've been in the market before. They failed the first time round. So what we're seeing with investors actually on East African Breweries is, before, what had happened to the price was that they had actually priced in the expected rights issue. So when East African Breweries announced that this will not be going through, right. So the investors are looking at East African Breweries at a bit of a discount. So they're coming in and picking up these stocks, and we expect it to actually move upwards going forward.
Indeed. Let's move over now to the fixed income market. And on that side, yesterday we saw the treasury bill yield climbing to 17.1% from 16.859% in the previous auction. Now, this is on the 91-day bill. The surprise for me there is that you have got these huge rejection rates, and at the same time, you've got investors demanding higher yields. What are investors pricing into these higher yields that they are demanding?
Basically, what we're seeing is there's a lag effect. I think for most investors, it's still not come through that rates are coming off. What we've seen, for example, in the interbank, that yesterday closed at about 16%. So investors are still bidding at the levels we were seeing that were expected about 2 to 3 weeks ago. But there's a lot of liquidity that's coming in December, about 49 billion. So this is being priced into the overnight rate, and in essence, CBK also expect rates to come off. So they're rejecting these bids, and they're pretty sure that they're going to pick up all this money at probably lower levels, because also January has maturities of about 47 billion. Right. So we expect rates to come off, especially in December and January. And we'll see a lot more interest in the T-bills, especially the 91 and 182-day T-bill. These have been undersubscribed for the last about 2 months, 8 weeks. Right. Yesterday, we saw the first oversubscription in a while for the 91-day. about 9 billion. Well, the government was looking for about 4 billion. So I think CBK are sitting pretty now. They know they'll pick this money probably at lower rates come the end of December or towards early January, when investors have no choice but to put their money in T-bills when interbank comes below levels of probably 14–13%. Yeah,
but could also the market be sending a message here to the central bank to say that they expect inflation to be higher than where we are now, and therefore they want more reward for their buck?
I think it's highly unlikely, because we expect inflation to come off. All the factors point towards this. Energy costs are coming down. That is, electricity is coming down in December. Fuel costs are coming down by about 3 to 5 shillings also in December. We expect the agricultural sector to do really well. 2011 has seen very good rains. So, all these factors put together come the first quarter of 2012. We expect inflation to come off quite significantly. So inflation will not rise up. Basically, I just stick to my point. I think it's just a lag effect. Right. The market still hasn't gotten the concept that the rates are coming off, and they're not going to get levels of 20%, 25 to 30% that they were getting before in the interbank market. Yeah. So for the next maybe 2 to 3 months, we should see the rates at below 15%.
So Ken, what does that do then to your investment strategy for 2012? Do you see yourself then perhaps, or suggesting to fund managers that perhaps what you should be looking at here is a rejig of the weighting of those asset classes, perhaps moving out of fixed income now that there's that expectation that rates will have peaked by perhaps the first quarter of 2012?
Yes, I actually do think so. I think what I would do is I would lock in my rates now. If I can get 17%, between 17 and 20% for 3 to 6 months, or even for 1 year, then the 364-day T-bill was at about 20%. And also the 2-year that was just issued actually this week, they did some tap sales, which was at 22.8%. I would lock my money in for 1 to 2 years because I think we actually have seen the peak. There still remains a lot of pressure on central bank to meet the government's borrowing target in for the fiscal year 2011, 2012.
Right.
But I think rates have peaked. For the time being, rates have peaked, and I would lock in my money at the moment for anything between 6 months to 2 years.
What of the shilling then? What's your outlook for the shilling? Because in all these calculations that we're making and the assumptions that you're putting up, there must be an expectation that the shilling will remain stable. Will it in fact remain stable, do you think, given all the factors that we've outlined, perhaps better growth next year, but inflation coming off and perhaps interest rates coming down?
The shilling is performing beautifully. I mean, if you look at about a month ago, let's say 6 weeks ago, when it hit a high of about 107, we had lost almost 33% year to date. Depreciated 33% almost year to date, but now we're at about 10.5% year to date, which is beautiful. That's almost 20%, a 20% gain. So, and going forward, I expect the shilling to continue holding strong, especially putting a lot of emphasis on the agricultural sector. We expect exports to really improve. The tourism sector is expected to grow by about 17.6%, especially in this high season for 2011. So all these factors will act to strengthen the shilling. So we expect it to stay stable and actually may strengthen some more going forward. The biggest threat, I think, at the moment is going into 2012 to the shilling is the elections. So a lot of investors may price in political risk. So we may see this, this actually is the biggest threat to the shilling at the moment.
Okay. What about the impact that we're likely to see on the shilling coming from the crisis in the eurozone? What kind of an impact do we see coming into there? And perhaps, I mean, when you talk about all emerging market currencies, the expectation is that unless the European crises are resolved, we're likely to see emerging market assets and therefore, by implication, emerging market currencies coming under pressure into 2012 until we see strong political action coming from the Europeans starting from today.
Yeah, that's pretty true. We're all waiting to see what the ECB decides today. And that's also quite a threat, especially if the eurozone goes into recession. That is one of our biggest export markets. So this may affect our exports, especially agricultural exports. Yes, okay, I think I forgot. And that actually does remain quite a bit of a threat on the Kenya shilling. But looking at all other factors, I think we're looking at a pretty positive year in 2012.